Hi everyone, I'm Russell Muldoon from Montgomery Investment Management and welcome to this week's video insight. Well, for today, I'm going to keep things simple and focus on three key elements that we consider to be important when identifying investments and also managing our portfolio. For simplicity, we've broken down these categories into quality, quantity and return considerations. Now, in terms of quality, which often means different things to different people or different investors, for us, quality simply refers to a company's ability to earn high returns on invested capital for a sustained period of time. At Montgomery, we'd much rather own a handful of businesses that can reinvest meaningful amounts of capital back into the company at 20% per annum than 100 businesses in the same sector doing the exact same thing but generating just 5%. If you can identify a business that has an extended competitive period and is able to generate a high return on every dollar it reinvests, it's highly likely that its growth prospects over the medium term are going to be attractive. Now, in our experience, a portfolio filled with businesses of these characteristics will often perform very solidly over the long term, and hence we aim to fill our portfolio with these, and we think you should too. The second point I'd like to briefly touch on today is quantity. Once you've identified such a business, just how many should you aim to hold in your portfolio? Again, this is likely to differ depending on who you ask, but it's a well-known academic fact and being well published in academic research. The majority of benefits from diversifying away risk accrue in a portfolio of just 10 businesses, with marginal benefits of adding more and more diminishing quickly thereafter, and in particular when a portfolio is filled with 20 more businesses. In our view, this makes sense. And indeed, we can see little point in adding money into our 30th best idea when we can just add more and more into our number one or number two best ideas. So when it comes to building your own portfolio, think about how you could be backing your best ideas more meaningfully and avoid diversifying broadly, as this will likely lead to you building a library of investments which will fail to deliver the outcomes you seek. And finally, in terms of return considerations, while most people I often speak to are constantly trying to pick winners in the stock market, we believe that avoiding losers and making the dumb mistakes in the share market is just as important. Always remember a simple mathematic fact. Very simple. If you lose 50% of your capital, you have to generate a return of 100% just to break even, which can put you at a significant disadvantage if you have some poor performers in your portfolio. Now, as part of our research at Montgomery, we undertake, and indeed well before we ever push the buy button, we ask ourselves how much can we, before we ask ourselves how much can we make, we first ask ourselves how much can we lose. If we are considering an investment that can make us a little but has significant downside risk, then the investment idea probably doesn't stack up. The risk to reward ratio is simply not in our favour. Rather, we attempt to fill our portfolio where the situation is reversed. That is, where the downside risk is limited in our view, but we have reason to believe that there's materially more to the upside. In that way, you tilt the risk to reward ratio in your favour, and hopefully in the end, the returns. Well, that's all for me this week. Please remember to follow us on Facebook and Twitter, and for more great insights for the team here at Montgomery, keep coming back to rogermontgomery.com daily, and I'll see you next time. Thanks for watching.